My name is Ryan Diamisi. I work for Christian Wealth Management as a wealth advisor, and my mission is to help people use their money as a tool to build their faith. Today, we're talking about a 15-year mortgage versus a 30-year mortgage. So to start, we got to define the obvious, which is what's the difference between a 15 and a 30-year mortgage. So a 15-year mortgage, as it implies, means you will pay it off in not 14, not 13, but you guessed it, 15 years. And a 30-year mortgage is the same. It means at the end of 30 years, it will be paid off. If you're asking the obvious question of why would you want a loan for 30 years when you can get one for 15, it's because a 30-year mortgage is going to offer a lower payment. And as a friend said earlier today, an average American can't afford a 15-year mortgage. It would be nice, but it's just unachievable. So people resort to the 30-year mortgage because of the lower payment. Okay, so we're going to walk through a comparison of a 15-year and a 30-year mortgage. And the numbers are going to assume we're going to borrow $320,000 for a house. So if in the 15-year term, we're going to get a 6% interest rate. That's what's assumed. In the 30-year term, we're going to assume we're getting a 6.75% interest rate. And you are more risk to the bank if you're lending for a longer period of time. So they will charge you more interest than a 15-year. So in those two scenarios, the 15-year for over the entire life of the loan, you're going to pay $166,000 and some change. And for the 30-year, you're going to pay $427,000 of interest. So remember, your house was $320,000. In a 15-year, you're paying half of the value of the house to the bank, which that already in of itself is a lot. And then a 30-year, you're paying almost 1.5 times the value of the house to the bank. In both cases, you're paying a lot of interest. But what I want to think through now is what's the disadvantage of doing a 15-year versus a 30-year? And I'm cheating because I'm using Dave Ramsey's article. Dave Ramsey's awesome. Oh, he's not there anymore. He got kicked off by the tortoise and the hare. The disadvantage of getting a 15-year over a 30-year mortgage is you're going to pay a higher monthly payment, and that's going to impact your cash flow immediately. So it's going to be a tougher strain on your finances in the short term to get a 15-year mortgage. So let's consider the disadvantage of a 15-year mortgage over a 30-year. The disadvantage is the monthly payment in the same situation we just mentioned. You're borrowing $300,000 at 6%. Your monthly payment's $2,700 a month. Where if you chose the 30-year, your monthly payment would go down from $2,700 to $2,076 a month. So your cash flow in the short term is going to be negatively impacted if you get a 15-year mortgage. So a creative alternative people also often come up with is, why don't I just get the 30-year mortgage and just put extra payments towards it so I can pay it off in 15 years? And they think they're geniuses that just came up with that strategy. But the reality is, if you get a 30-year mortgage, I've almost never seen people actually put the extra money towards their mortgage. There's a lot of factors that go in to why I think that happens, but the challenge is just, will you actually follow through with putting the extra payment towards the principal, where the 15 years, you're required to do it. The 30 years gives you the option, and something's going to come up that's going to give you a good excuse to not put that money towards the mortgage. So why should you choose a 15-year mortgage when the world is telling you to get a 30-year mortgage? Most likely, the bank is telling you to get a 30-year mortgage. So here's some examples of why you should choose a 15-year. The first one is the obvious, which is interest saved. We just went through the example that in a 30-year, you're paying about $260,000 more in interest than you would in a 15-year. The next reason for getting a 15-year mortgage would be you're building up equity faster. So if you look at the amortization schedule, which is just your sequence of payments over the duration of the loan, the life of the loan, you'll see at the beginning of a 30-year mortgage, you're having about 80+% is interest going towards the bank. So if you're making a $2,000 payment, around $1,600 a month or more is going to the bank in interest. So very little equity is being built. But with a 15-year, you've got over 30% of your payment is going towards equity. So you're going to be building up equity faster in a 15-year, and you're going to see the progress of your house being paid off faster. Seeing progress in something you care about is extremely motivating. Another benefit would be at the end of 15 years, you get a bigger raise because you're making a bigger payment, and that raise is going to come sooner. So it's not 30 years from now, it's 15 years from now, and it's not a $2,000 payment that you're getting back, you're getting a $2,700 payment you're getting back. So the next 15 years you'll work on through discipline, learning to live on less, and you're going to get a nice little pay bump. The last one, and probably the most substantial, is the example that you're going to set to your kids of living within your means. Because if you choose a 15-year, you're most likely going to have to choose a more humble home. That's going to say something to your kids of sacrifice and learning to live within your means and contentment. And all that stuff matters when you're thinking about passing wealth to the next generation. So that is my case, as you will, to choose a 15-year over a 30-year mortgage. It's always a good idea to consult God for what He'd have you to do before making big purchases like a home. That's all, Miles.
That's great.
Can I just say I'm a fan of Dave?
Yeah.
So I'm a fan of Dave Ramsey. And the information I was pulling from was an article that Ramsey Solutions wrote called 15-year versus 30-year mortgages, What's the Difference? And it was written at the end of December 2024.